Hello, so this would be our discussion for the next module, which is on cost estimation. This is still under management, accounting, and control as an introduction to to our to our discussion about cost, volume, and profit relationships. Now, what is cost behavior? This is how a cost will react as changes take place in the level of business activity. So, this is the reaction of a cost in a change in a certain activity of a business. So, it might react accordingly, or it might not have a reaction in relation to the cost in total. So, we would define them later in detail, but I believe that we have already mentioned them as a preview on basic cost concepts. Cost analysis, this is an integral part of the planning and control function of an organization. Cost analysis helps us in identifying costs that can be manageable or costs that can be controlled by the organization in order to attain cost leadership, because the ultimate goal of cost leadership is minimize costs at the at the most at the situation wherein we would not forego any opportunities that might arise. So, cost behavior patterns. We have different manners to which costs behave in relation to business activity. When we say that the cost is a variable cost, it changes in total as the level of activity changes in the short run and within the relevant range. So we mentioned here in the short run because, as mentioned in the earlier module, ultimately all costs in the long run change as a result of the change in business activity. So let's not be confused on that concept. For now, we will focus on the concept of variability of cost in the short run. So this pertain to the business activity of production or hours incurred in an organization. So when an additional item is produced, variable cost in total increases as a result of that change in business activity. So we have mentioned here the concept of relevant range. What is relevant range? This is the range of activity within which assumptions relative to variable and fixed cost behavior are valid. What assumptions are that? Those are variable costs will change in relation to the activity level on a direct manner. So a unit change in production would correspond to a certain amount change in variable cost, total variable cost, and that unit change is directly proportional to the change in activity level. So how do we define this relevant range? There are a number of factors, one of which is capacity. So meaning fixed costs, on the other hand, will not change in this relevant range. So regardless of the units that you will produce. But remember that production has also its capacity. For example, you can only produce 100,000 units in your current capacity. If you plan to produce 150,000 units, of course, variable cost per unit will change. But on what manner? Maybe because that already exceeds your capacity, you will need to incur overtime costs. Then the assumption of relevant range is not anymore valid. Also, you would have to get additional machineries. On that note, we will incur additional fixed costs. So that is what we are trying to pertain when we say that the analysis or the assumption on the cost behavior patterns are within a specified relevant range. So for purposes of analyzing, unless it is otherwise stated, we are within the relevant range, or unless the circumstances state so. Variable cost per unit is constant in the relevant range. As mentioned earlier, the change in total variable cost is proportional to the change in activity level. So for example, per additional unit of item produced, total variable cost will increase by 20 pesos because that is the variable production cost per unit. So meaning, if you will produce 1 unit, you will have a variable cost of 20 pesos. 2 units, 40 pesos. 3 units, 60 pesos. The total variable cost increases in relation to the activity level. But variable cost per unit is constant. If you will produce 1 unit, how much is the variable cost per unit? 20 pesos. If you will produce 2 units, how much is the variable cost per unit? Since the total variable cost is now 40 pesos, you will have a variable cost per unit of 40 divided by 2, still 20 pesos. 3 units, 20 pesos. 1 million units, it would still be 20 pesos, assuming that is within the relevant range. Total variable cost changes with respect to the activity base. So they have a direct relationship. When the activity base, activity level increases, total variable cost increases as well. What is the activity base? Measure of whatever causes the incurrence of variable cost. This may be units produced, this may be machine hours, labor hours, whatever is the cost driver. Now we move with fixed costs. Fixed costs is a cost that remain constant in total regardless of the changes in the level of activity within the relevant range. So, for example, if depreciation of 10,000, if you will produce 1 unit, depreciation is still 10,000. 2 units, 3 units, 100 units, still 10,000. So it is not affected by the total fixed costs. Fixed cost in total is not affected by the level of activity. However, fixed cost per unit decreases as the level of activity increases. For example, if you will produce only 1 unit and your fixed cost is 10,000, how much would be your fixed cost per unit? 10,000 divided by 10,000. If you will produce 10 units, how much would be your fixed cost per unit? 10,000 divided by 10, that would be 1,000 per unit. So see the effect of the increase in production with fixed cost per unit is inverse as compared to variable costs, wherein variable cost per unit is not affected by the activity level. So on a per unit basis, variable cost is fixed while fixed cost is variable. But the relationship of the activity base and the fixed cost per unit is inverse. The higher the activity level goes, the lower the fixed cost per unit becomes. And that is a helpful analysis when we consider variable and absorption costing, because it helps us identify that fixed cost actually when spread out to more units, it would be lower as compared to when it is spread out on few units. We have 2 types of fixed costs. Committed fixed costs, these are long-term in nature and cannot be significantly reduced even for short periods of time without impairing the profitability of long-run goals of the organization. So these are costs that we have already agreed to pay in the long run. Discretionary fixed costs, these are fixed costs which we can still avoid as a result of its nature. So we do not have an agreement as to payment of this type of fixed costs. Now we have what we call mixed costs or semi-variable costs. So these are costs with variable and fixed elements. Ultimately, these costs are depicted in this equation: y is equal to a plus bx. So if you would remember this formula, this will be very familiar to you because this is the slope-intercept formula as well. Y is equal to mx plus b. Well, where m is the slope and b is the intercept. So in here, A would be the fixed cost and B would be the variable cost. Ultimately, mixed costs have fixed and variable components. That is why in this chapter, or in our discussion for this chapter, we will identify methods on how to separate fixed and variable components in a mixed cost. So the fixed portion would most probably be the bare minimum of cost that we have to pay, while the variable portion would be the incremental cost that we incur as activity level increases. So what is a perfect example of this? Electricity. We are paying a minimum amount for the retention of our electricity in our households. But we also have variable amounts which increases as the level of consumption increases. We also have water bill. Water bill, I believe it is on our area, the minimum water charge is 200, and if you exceed a certain consumption, you would pay additional amounts. Now we go to the methods of cost estimation. We have different methods of cost estimation which we will actually not use. No, we will not use every item here. We will only use a select few because some items here are cost estimation methods that are subjective in nature. So we start with the account analysis method. So this makes use of the experience and judgment of managers and accountants who are familiar with company operations and the way costs react to changes in activity level. So how do we do this? We review each cost and identify whether they are variable or fixed. And then we will itemize each major class and divide them into variable and fixed component. So as the title suggests, we will analyze and then we will determine whether it is fixed or variable. The advantage of this is it would require a detailed examination of the accounts, while the disadvantage is it is a judgmental approach. So it depends on how the person analyzing sees the account, on whether it is fixed or variable. Now we go to industrial engineering method. So this estimates cost function by analyzing the relationship between inputs and outputs in physical form. So this requires the use of the knowledge of an industrial engineer on determining relationships between input and output and identifying whether they have an effect on the incurrence of cost. So the step here is study of physical relationship between quantities of inputs in relation to output. Now we assign cost in each of the physical inputs to estimate the cost of the output. So the advantage of this is it can detail each step required to perform an operation, because inputs versus output is the method of analyzing here. We will detail all processes and the required input per process in order to achieve the output. The disadvantage is it is expensive because you need an external assessor to identify your steps as well as the cost incurred in relation to them. Next, we go to conference method. As the title suggests, this is done in such a way like we will call each department and then we will ask them, this cost, what is this cost? Is it fixed? Is it variable in your opinion? So that is how we do that. It allows quick development of cost functions and cost estimates. However, the accuracy depends on the objectivity, care, and the detail taken by the people providing the inputs of information. So the way it is done, for example, the marketing department will be asked about the marketing cost. Of course, the marketing department would be subjective as to that cost. Or maybe, I hope they will not be subjective on that, because if they are, then they would highlight its importance, and at some extent we would not want to be associated with costs that are highly volatile, or costs that we believe we can control but we do not want to control. So if that is eliminated in an organization, then conference method has its own benefits as well, in such a way that we are asking those who are very familiar with the cost on the nature of the cost.